If you're an investor, understanding capital gains tax is crucial, especially when planning for your future. Capital gains tax is the tax you pay on the profit from selling an asset, like stocks, real estate, or even precious metals. The key to saving big on taxes lies in how long you hold that asset, and if you're a retiree with a substantial IRA or 401k, this can have a major impact on your wealth. Now let's break down what you really need to know about capital gains tax, and by the end of this video, you'll not only be equipped to make smarter investment decisions, but also have a clearer strategy on how to keep more of your hard-earned money. Here's the thing. There are two types of capital gains, short-term and long-term. If you sell an asset you've held for less than a year, you're hit with short-term capital gains tax, which is taxed at the same rate as ordinary income. For most Americans, that means up to 37% tax on those gains. But if you hold the asset for over a year, you qualify for long-term capital gains tax, which can be as low as 0%, 15%, or 20%, depending on your income bracket. For retirees who may have a more limited income post-retirement, long-term capital gains taxes could be a big win. If you're serious about protecting your wealth, like so many retirees are right now, make sure to check the first link in the description. Thousands of Americans are opening gold IRAs to protect their savings from inflation, market volatility, and yes, capital gains tax. Gold IRAs are a fantastic option because they allow you to diversify your wealth while potentially reducing your exposure to taxes. It's something every American retiree with $100K or more in their IRA or 401k should seriously consider. But let's talk about the bigger picture. When you're calculating the impact of capital gains tax, it's not just about holding an asset for the right amount of time. You also need to be aware of things like tax deductions, tax loss harvesting, and how your investments are structured. For example, you might think about offsetting some of those gains by selling investments at a loss, which can help reduce your overall taxable income. But remember, these strategies only work if you know when and how to use them. Now, here's something that might surprise you. Despite the potential tax advantages of long-term capital gains, many investors overlook something even better. I'm talking about gold IRAs. When you hold physical gold in an IRA, it's tax deferred until retirement, meaning you don't pay taxes on the gains until you start withdrawing in retirement. It's a way to preserve your wealth without worrying about those pesky taxes eating into your profits every year. If you've got substantial savings, this could be the right move for you. It's easy to get distracted by other investment vehicles, but don't forget about tax strategies that can benefit you specifically as a retiree. Many people overlook the tax-deferred growth in a gold IRA simply because they don't know enough about it or they're unsure where to start. Well, you're in the right place because gold IRAs are a tax-smart way to help protect your wealth while keeping the taxman at bay. At the end of the day, the smartest investors know how to navigate the rules to their benefit, and understanding how capital gains tax works is just one piece of that puzzle. If you're thinking about long-term wealth preservation, a gold IRA could be the perfect strategy, especially for those with more than $100K in their IRA or 401k, or even $5 in savings. For those looking to take control of their wealth today, don't hesitate to grab your free guide by clicking the first link in the description. You'll find out why thousands of Americans are turning to gold IRAs to protect and grow their wealth in the current economic climate. This guide is perfect for anyone serious about securing their financial future in the next 2 weeks. In conclusion, by holding investments for the right amount of time, leveraging tax strategies, and considering a gold IRA, you can maximize your returns while minimizing your tax liabilities. It's time to stop letting taxes eat into your hard-earned wealth. Take action now to make sure your capital gains work for you, not the IRS.